So there's call it the big print camp where people say, a thing's just around the corner, we're going to print a ton of money, like COVID. People have been saying that since a year or two ago, and it's not really happened. And I've been in the camp that no, we're in a gradual print scenario as a base case, meaning that, and this was before the Fed started ending their balance sheet reduction and resumed growth. My view was that was going to happen, that they were going to end it. They were going to go back to roughly increasing their balance sheet in line with nominal GDP, to kind of maintain kind of a persistent percentage of nominal GDP, roughly speaking, or like a persistent percentage of, say, total bank deposits, kind of a proxy for broad money supply. And that's roughly what they're doing. They're in a gradual print scenario, which we're running $2 trillion deficits. Those are going to keep maintaining and growing as far as the eye can see. Nothing stops that train. The central bank will monetize a portion of them where necessary to keep liquidity in the banking system, keep liquidity in the treasury market, and all this. And all of that is this kind of this persistent background debasement inflation.
That statement alone changes how you should think about everything happening right now. Because the dominant narrative says inflation is something that can be controlled, that central banks can step in, raise rates, and eventually bring things back to normal. But what you just heard suggests something very different. It suggests that the system isn't temporarily out of balance, it's operating exactly as it's designed to under these conditions. A system running multi-trillion-dollar deficits every single year doesn't behave like a stable system. It behaves like one that needs constant support just to keep functioning. And that support doesn't come from productivity alone, it comes from expansion, from liquidity, from a steady increase in the monetary base that keeps everything moving forward. See, that's what a gradual print environment actually means. It's not explosive like 2020. It's not obvious. It's quieter than that. But it's constant. And over time, constant pressure is far more powerful than short-term spikes. Because if the system is adding debt at that scale, something has to absorb the cost. And historically, that cost doesn't disappear. It gets transferred through inflation, through currency debasement, through a slow reduction in purchasing power that most people feel but don't fully understand. And once you see it that way, the question changes. It's no longer, will inflation go down? It becomes, how does the system actually sustain itself going forward? Because if deficits are structurally locked in, and if policy is constrained by the size of that debt, then the system doesn't have many options. It adapts.
If you have something like total war or like a nuclear bomb gets dropped or something, I mean, then you can enter kind of all at once territory. But for the most part, these things tend to happen in phases. With the U.S., I mean, we mentioned before how in many metrics, the late 90s and 2000 were kind of like the peak U.S. In terms of disproportionate power to the rest of the world. And you kind of map out what happened since then. I mean, 9/11 happened in 2001. Then all these wars, the war on terror. I mean, I think Brown University estimated we spent something like $8 trillion on the war on terror.
That's the part most people misunderstand. They expect one big collapse, one clear moment where everything breaks. But that's not how systems like this usually fail. They don't fail all at once. They degrade over time. Crisis, response, temporary stability, then another crisis. And each time that cycle repeats, something changes. More debt gets added. More intervention is required. The system becomes slightly more fragile, slightly more dependent, slightly less flexible. If you zoom out over the past 2 decades, the pattern becomes obvious. The financial crisis, massive bailouts, then years of monetary support, then COVID, even bigger stimulus, then rising geopolitical tension, now structural deficits that don't go away. Each phase adds pressure, each phase pushes the system further into a position where it can't easily reverse course. And that's where the real constraint appears, because once debt reaches a certain level, policy stops being about choice and starts being about necessity. You can't raise rates too aggressively without breaking something. You can't cut spending without causing instability. You can't unwind liquidity without triggering stress in financial markets. So instead, the system does what it can. It moves forward. But it does so under increasing pressure.
I separate Bitcoin and stablecoins from kind of the rest of the space. I think that broader crypto is kind of stagnating going forward. I mean, it has ups and downs, but I think it's generally structurally stagnating. And I think the areas of opportunity, I still think Bitcoin is going to be a larger network. I don't think the $2 trillion market cap that it reached was the peak. I think it'll go higher because I think there's a demand for a decentralized ledger backed by energy and kind of a portable store of value and permissionless payments. I think that there's a lot of demand for that. Um, and there's self-reinforcing network effects. Kind of like how when you have simple mail transfer protocol or TCP/IP or Ethernet or USB, when you have a software or hardware protocol, these things tend to be very self-reinforcing. It's a winner take all.
Now, this is where things get even more interesting, because when you move into an environment defined by structural pressure, not everything survives equally. Liquidity doesn't flow evenly, capital becomes selective. And in that kind of system, weaker assets tend to fall behind while stronger networks consolidate. That's exactly what she's describing here. The broader crypto space may continue to exist, but structurally, it's not positioned the same way. It doesn't have the same level of demand, the same network effects, or the same long-term use case. Bitcoin, on the other hand, is being framed very differently. Not as a short-term trade, but as a system-level asset. Something that benefits from the exact conditions that are putting pressure on the traditional system. And that distinction matters, because in a constrained environment, survival is not random. It's structural.
And then people also wondered, well, okay, why didn't Bitcoin sell off? It's usually a risk-on asset. Why didn't it sell off amid the crisis? It's like, well, it already had the opposite problem. It already sold off a ton in late 2025 and early 2026. All that fast money is already out of this ecosystem. The coins are held by pretty strong hands. And so there's not a lot of money that is still there to get out. And so it holds up surprisingly well. I mean, who would have thought, okay, the U.S. attacks Iran, we have the biggest energy shortage in the world, and Bitcoin outperforms gold for a month. Who would have thought? But it's like when you get very overbought in one and very oversold in the other, things can happen. And similarly, like people were like, oh, does this mean Bitcoin's a safe haven asset? My view is no. It just means the fast money was already out.
This explains something that confuses a lot of people. Why didn't Bitcoin collapse during periods where it normally would? Because the structure of the market changed. The weak hands, short-term capital, speculative flows already exited earlier. What remains is a more stable base of holders. That doesn't mean volatility disappears, but it changes how the asset behaves under stress. Instead of reacting immediately to every macro shock, it absorbs it differently. And that creates a very different dynamic going forward. Because if the system continues to operate under these conditions, gradual printing, structural deficits, repeated cycles of stress, then assets that are aligned with that structure behave differently from those that aren't. They don't necessarily explode higher immediately, but they hold, they consolidate, and over time, they attract more capital as the system evolves.
I still think Bitcoin is going to be a larger network. I don't think the $2 trillion market cap that it reached was the peak. I think it'll go higher because I think there's a demand for a decentralized ledger backed by energy and kind of a portable store of value and permissionless payments. I think that there's a lot of demand for that. And there's self-reinforcing network effects.
That's the long-term view. And it only makes sense when you connect it back to everything else. Because if the system continues on this path, if deficits remain high, if liquidity remains necessary, if cycles of crisis and intervention continue, then the environment that supports assets like Bitcoin doesn't go away. It strengthens, not in a straight line, not without volatility, but structurally. And that's the key difference between how most people view markets and how they actually evolve under pressure. Most people look for short-term signals. They look for confirmation. They wait for clarity. But by the time clarity appears, the structure has already shifted. And that's what this entire discussion points to. Not a sudden collapse, not an immediate explosion, but a system that is gradually changing in ways that are difficult to reverse. And once that process is underway, it doesn't stop easily.